Okay, I want you to imagine something for a second. It's a perfectly normal Monday morning. You wake up, pour yourself a cup of coffee, and you casually open your banking app on your phone, just to check your balance like you always do. But as the screen loads, your stomach absolutely drops. Almost half of your life savings has just vanished, completely disappeared overnight. You frantically refresh the app, thinking it's a glitch, but there's no error message. The reality slowly sets in. Your money was legally seized. And the craziest part? It wasn't taken by a shadowy syndicate of hackers halfway across the world, and it wasn't stolen by armed robbers in ski masks. It was taken by the very institution that was supposed to keep it safe. It was taken by your bank.
Now, this isn't some crazy theoretical scenario cooked up for a Hollywood thriller, and it's definitely not dystopian fiction. This actually happened. It was a very real, highly coordinated financial maneuver that evaporated billions of dollars without leaving a single trace. And today, in this explainer, we are going to unravel exactly how the rules of global finance were completely rewritten over a single, frantic weekend. We're going to look at how an unprecedented mechanism was quietly deployed, and most importantly, we're going to talk about what this means for the safety of the money sitting in your checking account right this very second.
To really wrap our heads around how this ultimate, legalized financial extraction was pulled off back in March of 2013, we actually have to rewind the clock a bit. We need to start our story in a place that seemed completely blissfully oblivious to the impending doom. We're going to a place that had engineered an absolute economic miracle. A place where the yachts were massive, the corporate profits were soaring, and the money just seemed to compound endlessly. But beneath all that shiny surface, a truly spectacular financial trap was being set.
Which brings us to Section 1, Moscow on the Mediterranean. So our setting for this whole story is the Republic of Cyprus. If you don't know it, it's this incredibly beautiful, sun-drenched Mediterranean island nation with a tiny population of just over 1 million people. Historically, Cyprus was mostly known for stunning beaches, tourism, a great vacation spot. But the country had a much, much grander vision for its economy. Right after the dissolution of the Soviet Union, Cyprus positioned itself to become a massive global offshore banking hub. They completely transformed their economy from modest local commerce into this magnetic financial paradise for wealthy foreign investors. They rebuilt their entire financial infrastructure from the ground up to cater to the global elite, the people who needed to move massive amounts of capital quietly, legally, and very efficiently.
To pull this off, they created what became known in elite financial circles as the Cyprus model. And man, was it lucrative. If you were a high net worth individual bringing your millions to Cyprus, you were greeted with incredibly low corporate tax rates. The local banks offered these sky-high interest yields on your deposits, returns that you quite literally could not find anywhere else in Europe. On top of that, they sweetened the deal with a golden visa program. This essentially allowed elite investors to buy European Union citizenship, which instantly granted them unfettered access to the broader European banking sector. And perhaps the biggest draw of all? They offered an ironclad system of extreme corporate secrecy, backed by an absolute army of lawyers and accountants who asked very few questions about where all this money was actually coming from.
And the results of this business model were just staggering. Honestly, it worked almost too well. By 2012, the influx of foreign wealth was astronomical. Just looking at Russian corporate and banking deposits alone in Cyprus, that number sat at an astonishing $31 billion. Let's just put that into perspective for a second. That single demographic of depositors held more money in Cypriot banks than the total value of the entire island's economy. Cyprus had officially become the beating heart of a shadow financial system, processing immense wealth and churning out massive profits. Everyone involved was getting rich. But as any seasoned investor will tell you, when yields are artificially high, the risk is always there. It's just hidden, silent, and potentially deadly.
And that leads us straight into Section 2, the toxic debt trap.
So here was the fundamental business problem. To actually pay out those incredibly high interest rates to their wealthy depositors, the Cypriot banks had to generate a massive amount of return on that capital very quickly. They had to take on risk. As a result, look at this chart, the Cypriot banking system had bloated into an absolute monster. The banks grew to a staggering 400% of the entire country's gross domestic product. They had become vastly larger than the actual nation that hosted them. They were the definition of too big to fail, but tragically, the island itself was entirely too small to save them if the market suddenly turned against them.
Let's look at the actual math here, because it's pretty wild. The nominal GDP of Cyprus was sitting around 19.5 billion euros. Meanwhile, total bank deposits had ballooned to $120 billion. But here is the fatal flaw, the absolute poison pill sitting on their balance sheets. Because these bank executives were desperately chasing high yields to keep the whole party going. They took those billions in deposits and they bought heavily into Greek private sector debt. They amassed 22 billion euros in Greek debt. That is an exposure larger than the entire economic output of Cyprus itself. They had effectively tied the survival of their massive banking empire directly to the stability of their neighbor, Greece.
And then, the dominoes began to fall in a merciless macroeconomic chain reaction. Step 1, the 2008 subprime mortgage crisis in the US triggered a massive global economic downturn, which choked off the flow of easy money. Step 2, by 2009 through 2012, a localized recession hit Cyprus hard. Commercial property values plummeted by 30%, and non-performing, bad loans spiked up to 6.1%. The foundation was severely cracking. And then came step 3, the absolute kill shot. The sovereign debt crisis exploded in Greece. European regulators stepped in and forced a massive haircut on Greek bonds, meaning the value of that debt was drastically slashed. And because the Cypriot banks were holding 22 billion euros of that newly toxic debt, their balance sheets were absolutely decimated in the blink of an eye. The banks were instantly insolvent.
They needed a bailout immediately, or the whole country was going under. Which brings us to Section 3, a weekend of panic.
What happened next over a single weekend of intense, closed-door negotiations in Brussels would end up shocking the global financial system. On March 15th, the Troika, that's the European Commission, the European Central Bank, and the IMF, proposed a bailout deal that included a tax on all bank depositors, even small everyday retail savers. Well, the public outrage was immediate and it was explosive. Depositors rushed the ATMs, which had to be quickly capped to prevent a total bank run. On March 19th, reading the absolute fury of the public, the Cypriot parliament unanimously rejected the deal, 36-0. But the European Central Bank wasn't messing around. They played hardball. On March 21st, they issued a terrifying ultimatum. Agree to a new deal, or we completely cut off emergency liquidity assistance to your banks by Monday. Cyprus would literally collapse into the dark ages. This threat forced marathon, desperate talks that finally resulted in a draconian 10 billion euro bailout package on March 25th.
Now you really have to understand the sheer brutality of this final deal. To secure that 10 billion euro lifeline and stay in the Eurozone, Cyprus had to agree to unimaginable terms. First, they had to permanently shut down their second largest bank, Laki Bank. Just close the doors forever, wipe it out. Second, they had to aggressively restructure the Bank of Cyprus, which was the island's largest financial institution. Third, they would protect all retail insured deposits under 100,000 euros. But fourth, and this is the crux of the entire story, they agreed to legally seize uninsured deposits over 100,000 euros to cover the gaping hole of debt. They agreed to a financial operation no one had ever dared to execute in the Eurozone before.
And that is where the heist actually takes place. Section 4. The unprecedented bail-in.
What they used is a mechanism called a bail-in, and it represents a complete reversal of how the modern world thought financial crises were handled. A bail-in is a rescue mechanism where a failing bank's own creditors and its own depositors are forced to bear the burden of the bank's losses. So instead of relying on external taxpayer funds from a government rescue, the bank looks inward. It legally confiscates the funds of the people who trusted it with their money, or it forcibly converts those seized funds into equity, meaning you suddenly own shares in a dying bank instead of having cash in your account.
To really grasp this, think back to the 2008 Wall Street crash. That was the era of the bailout. In a bailout, the public, the taxpayers, foot the bill to save massive failing banks while the depositors' money remains fully protected. The government steps in as the savior. But in a bail-in, the bank itself becomes the predator. It executes an internal rescue where wealthy uninsured depositors simply have their funds stripped away and confiscated overnight to recapitalize the institution's balance sheet. The European Union basically decided that German and French taxpayers shouldn't have to pay to save a bloated offshore haven, so they forced the depositors themselves to take the catastrophic hit.
The math enacted on that fateful weekend was absolutely ruthless. Let's look at the fate of an uninsured depositor at the Bank of Cyprus. If you had money over the 100,000 euro insured limit, here is exactly what happened to it instantly. 47.5% of your money above that threshold was simply seized and converted into essentially worthless bank shares, just gone. Another 22.5% was completely frozen, locked away indefinitely without your consent to see if they needed to seize more later. Only 30% remained actually available to you. Imagine logging into your business portal and seeing those percentages apply to your company's payroll account or your life's investment fund. It's just evaporated, entirely legally, under the guise of financial stability.
But as crazy as that is, the story of this 5.8 billion euro confiscation doesn't just end with the vaporization of wealth. It ends with a deeply fascinating, incredibly bizarre twist of business fate. Section 5. The ironic aftermath.
You have to remember who actually held the vast majority of these massive, uninsured accounts. It was Russian oligarchs, massive corporations, and elite investors. The European policymakers were actually quite satisfied to offload the cost of this crisis onto wealthy foreign billionaires who were using Cyprus as a tax haven. The outrage from Moscow was intense. Russian Prime Minister Dmitry Medvedev famously stated, "They are continuing to steal what has already been stolen." It was a staggering, unprecedented wealth transfer from the accounts of Russian elites directly into the balance sheets of a European banking system. But the EU's strategy actually backfired in a spectacular and totally unintended way.
Because of how the strict financial mechanics of a bail-in actually work, a bank can't just take the money and offer nothing. They legally have to issue equity in return. So yes, billions in cash vanished, but to technically compensate these depositors, those seized funds were converted into actual shares of the Bank of Cyprus. Let's connect the dots here. By forcing these wealthy foreign depositors to absorb the most catastrophic losses in exchange for bank stock, the European bailout technically handed massive voting blocks and outright ownership of Cyprus's largest commercial bank directly over to the very Russian oligarchs they were trying to squeeze. It's a crazy irony. The victims of the bail-in became the new majority owners of the institution that had just robbed them.
And while this bizarre twist of ownership was playing out quietly in corporate boardrooms, a public statement sent absolute shockwaves across the globe. Shortly after the deal was struck, Eurogroup President Jerome Dijsselbloem gave an interview where he chillingly referred to this brutal depositor confiscation in Cyprus as a template for future European bank rescues. A template. That single word sent global markets tumbling. It signaled to investors everywhere that the days of taxpayer bailouts were officially over and the era of the bail-in had begun. If a bank failed in Italy, in Spain, or anywhere else, the depositors were now officially on the hook. Your money was no longer considered yours. It was legally considered an unsecured loan to the bank.
Which leaves us with one deeply unsettling final thought to wrap up this explainer. The 2013 Cyprus banking crisis proved that the unthinkable is entirely possible, and it's perfectly legal. Billions of dollars were taken without warning, completely rewriting the social contract between the saver and the institution in the span of a single weekend. The rules of the financial game can be changed while you are sound asleep. So I leave you with this question to chew on. If the institutions designed to protect your wealth can legally write the rules to confiscate it overnight, if the bank fails tomorrow, whose money is it really? Thanks for joining me on this deep dive, and seriously, keep an eye on your accounts.